run several successful businesses, and then found himself searching for the next best thing. And he is now in a business uh, for helping people. And his company is called Crush Your Debt. He knows more than anyone that you can fall down financially and pick yourself up. And he has dedicated himself to helping others find the right resources to get there. So because our mantra is really never to give up and back on track, our Catholic boy, our guy that went to Catholic school his whole life, who was probably a bad boy half the time, in his heart, he's the best of the best because he knows that God is first in all he does. And he's learned it the hard way, and he's loving it right now the easy way. So it doesn't mean that we don't need to work hard, and it doesn't mean that we don't need to seek out others. As you heard in Tom's talk, if you were fortunate enough to hear Tom speak a few weeks ago. So without further ado, we are going to learn how to navigate the financial world. I'd like to turn this over to our friend and team member, Bill Curtis. Clap,
Okay.
clap, 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 clap.
Hello, I hope I don't bore you people. I just want to introduce somebody who's here tonight, Karen Payton. She works with me. So she's going to be here. She's going to help me answer any questions that you might have. It shouldn't go too long. I tried to keep it within the bounds of 20 minutes, half hour or so. I'm probably going to tell you some things that you don't know, might upset some people, but what I'm going to bring up is the facts of finance that a lot of times we don't know, and that's what causes us to struggle in our lives. Okay, so let me get started. And what we're going to talk about first is a Bible verse, which states, Hosea 4:6, which states, "My people are destroyed for lack of knowledge." Well, tonight, hopefully, you're going to get some knowledge. What you do with it is up to you. All right. So why is everyone stressed out about their finances? Maybe they're out of work. Maybe they couldn't go to work because of coronavirus. Maybe they're working, but they're still stressed out. So what's the reason for that? Well, let's see if we can take a look. The median household income, I looked up for our general area. So, are people struggling financially? What's the problem? Well, if you live in Weston, the average income, household income is $96,000. If you live in Davie, it's $64,000. If you live in the rich city where Tom Whalen lives, he lives with all the rich people, that's $98,000. If you live where Bianca lives in Southwest Ranches, they're over 92,000. And the South Florida average is $53,000. So where's all the money going? Well, banking is a big part of what we do. And the guy that I say wrote the Bible of finance in my business is R. Nelson Nash. One of his quotes was, "Banking is the most important business in the world. Without it, all businesses will come to a screeching halt. If you're buying a car, you got to come up with the cash. If you're buying merchandise, you got to come up with the cash. Anything you want to do, money travels around the world it's like water. It travels around the world. So what I show people, if I deal with business owners understand the importance of cash flow. And what they realize is that they can have their best quarter or their best month in, say they have their best month in March, but in April, they can have trouble meeting their expenses and paying their payroll, especially if they sell on credit. And it happens in our household too. You know, it's a business. It's just sometimes a smaller business. You know, some months you got plenty of money. Some months it seems like you're a nonprofit, but cash is always coming and going. It's always flowing. The problem with most of us is it's flowing away from us. So the question is, how do you handle your cash flow? Do you pay cash for everything? Do you use credit? Do you barter, or do you do something else? Like when you don't have money, what are you going to do? So I'm going to talk about some of the things in business, some of the financial terms, some of the things that people believe that we've been taught that really aren't true. But yet we've heard them so many times, we believe them. So people say all the time, you know, hey, if I have money in the bank, isn't my money safe in the bank? You know, if anything happens, you know, it's protected, isn't it? Well, the chief reason business owners and households put their money in banks because they feel it's safe if they put it in the bank and it'll be okay. As a matter of fact, we have an expression that we use, hey, it's like money in the bank, you know, but is it really safe? Did you know that when you put money in the bank, it no longer belongs to you? It's now owned by the bank and you're only a creditor. So if something happens with the bank, you're on the hook. They don't, you know, and you'll see as I go into this, how they've changed the rules as time has gone by. Basically, you're an unsecured creditor. And you're probably saying right now, well, what about the FDIC? I hear that all the time when I talk about what I do. What about the FDIC? Isn't my money backed by a reserve fund? Yeah, it is. But like the people in Greece found out several years ago, when they found out that the government was doing some things with the money, they all got nervous and there was a run on the bank. And even though people had hundreds of thousands of dollars in the bank, they shut the bank down and people couldn't get their money. And literally, they were only allowed to take out like $68 a day. So, you know, is it really safe? Well, let's take a look. In the second quarter of 2017, the FDIC had 88 billion funds available to make depositors whole. You know, if anything happened, they had that money to take care of people. And it sounds like a lot of money. Well, we got $88 billion. The problem was there was 1.7 trillion deposits that needed to be insured. 7.1 trillion in deposits that needed to be insured. So if they had a run on the bank, they only had a little more than 1% to cover your money. So if you had $100 in the bank, they'd give you about $1.25. You know, but we all have the faith that we're protected by these things that we've heard since we were kids. So let's look at some things that's worth pointing out. We all remember the 2008 financial crisis. Well, in September of that year, after the crisis, after they, you know, took care of, bailed out all these banks, the reserve that they had was actually minus $8 billion in September of 2009. Now, no one lost money because the FDIC tapped the credit line of the Treasury. But the government isn't the magic wand. It doesn't mean that they're always going to be able to do it. And you can see with all this money that was just put out that, you know, people scream, where's my coronavirus stimulus? The problem when rich people, they don't want the government to hand out money. The poorer people, they want the government. It's really not the government's money, but they want that stimulus checks. The only problem is every time the government prints money, it's a tax. Doesn't even have to get voted on. And the reason it's a tax, and it's equal for everybody, everybody pays the same tax. If you were going to buy that automobile and say it was $30,000, when they print money, it makes the dollar cheaper. And if the dollar's cheaper, that automobile is not going to cost $30,000 anymore. It's going to cost $32,000. Somebody making less income has to pay that $32,000. Somebody with a lot of money, they're going to pay the same $32,000, but it's a lot easier for them. So it's actually an unfair tax return. So this brings us to bailouts, right? We've heard, hey, the government bailed out the banks. Well, actually, the government didn't bail out the banks. The taxpayers bail out the banks. So what is a bailout? Let's talk in regards to the Dodd-Frank Act of 2010, because they wrote this law into the government to protect us so it wouldn't happen again. And if we had a problem like that, it would be a little different. So in 2008, the government didn't use their money because they don't have any money. They used taxpayer money to bail out banks for all the errors they made in all their loans. All the loans they made on mortgages, everything that they did, we were on the hook for it, not the government. Although everyone says the government bailout, it was the US taxpayers that bailed it out. But after that, the government made a decision with this Dodd-Frank Act, and they said, we will not kick money in anymore to salvage these banks. If they make a mistake in the future, we're not going to do it. So they came up with a bail-in. Does anyone know what a bail-in is? Well, you should, because you're on the hook for it now. What happens is that means that the shareholders and creditors being you, a depositor, will the next time that happens, will eat the shortfall. So you're on the hook for it. So don't listen to some of these things where people say, hey, you know, I got my money in the bank, I'm protected. Yeah, you're protected $1.25 maybe, if you're lucky. And if there's ever a run on the bank, you know, maybe if there's a run in California, not a problem. But you know what happens, just like what happened with the coronavirus, when everyone gets scared. And when there's a run on a bank, you better have availability of money somewhere that you can get at. Couple of things that people don't know. A lot of times when they're going for credit, usually they're going for a mortgage for a house. They can't get it because their DTI is debt to income ratio is too low. So a lot of times they can't get the mortgage. The realtor is not going to show them properties, and he'll tell them, or she'll tell them, hey, go to a credit repair person. Maybe they can get your score up. Well, when they go see a credit repair person, what those people are looking for are charge-off, late payments, bankruptcies, things that are derogatory that they can remove. A lot of times, they don't have any of that. You may be okay. You may be paying your bills. You're just struggling to do it. You know, you're making the payments. You're paying a little extra, trying to pay the mortgages or the debts off, your credit cards down. But so you're paying extra and you don't ever seem to get out of the way. 30% of your credit score is based on how much you owe. So if your credit cards are maxed out, you have a lot of debt, student loans and things, that's taken into consideration. And that's the reason why people struggle to try to get mortgages, because they don't know how to control their credit score. The other problem people have, don't take offense to this, where is he, Victor? I'm going to talk about financial advisors a little bit. When financial advisors, I always like to say they speak a foreign language. They speak in financial terms the average person doesn't understand. Well, I shouldn't say doesn't understand. That what they tell you, you have a different thought. And what do I mean by that? If you invested $100,000, and let's say they had a product, they show you this product, and you put the money in and it went up 40%. Hey, this is a great product. At the end of the year, you'd have $140,000 in that account. Let's say this year was the second year and the coronavirus hit. And that product went down 40% because the stock market went down. Well, you would have lost $42,000 and you would have less money than when you started. But this is the way the financial advisors and the financial world describes what happened. They say, look, you earned 40% the first year, you lost 30% the second year. So you averaged 10% over 2 years, and you essentially did. So if we take the 10% and we divide it by 2, they're going to tell you, and they're going to put in their brochure, hey, this product averages 5%. They're not lying to you, but you got less money than what you started. And here's what the average person hears. They told you this product averages, so this is what you're thinking. Hey, if I got 100 grand and I put it in this product and it averaged 5%, I'm going to have 105. If I leave it in the second year, I'm going to have 110. The problem is, this is actual earnings. It's not averaging. You actually have to earn the money because you've only got $98,000. It's less than what you started with. The difference is over $12,000. And the point I'm making is averages are meaningless. You actually have to earn the money. And what I tell everybody, even people I talk to, don't listen to a word I say or anyone else that's trying to sell you, whether it's a car, whether a guy's trying to sell you a mortgage, a realtor, anything to do with finances and money. I tell everyone, run the numbers yourself, because a sales guy is trying to sell you. You need to run your own numbers, because the numbers will tell you what to do. You might not do that, but when you run the numbers don't lie. They're going to tell you which way to go. So this is what financial people do. I call it selling the dream. They come out with a real nice brochure and they'll tell you, look, if you can invest $100,000 in this product, I've got it. They'll run an illustration and they're going to say, hey, they illustrate it. They have to illustrate it at something. They have it in a nice glossy brochure. And they're going to tell you, if you put this money in here for the next 12 years, it's going to grow. What I chose is years 1999 through 2010. Why did I pick that? It's called the lost decade, even though it's 12 years. They call it that because there was a lot of volatility. So when they give you the glossy brochure and they illustrate it, they say, put 100 grand in, 12 years from now, you can walk away. You're going to have $226,000. But what happened during that 12-year time, that lost decade, it didn't average 7.06%. The real average was only 4.02%. So instead of walking away with 226,000, you would have only had 160,000. You'd only make 60,000. So they're going to tell you, after they get this data, they're going to say, look, this product averages 4%. But I just told you that averages are meaningless. What actually happened during that period was a lot of volatility. You could see a lot of red numbers. So it didn't average 4.2%. Actually, it only made 2.26%. Not a big difference between 4.02, but the actual return, you would have only made $26,000, which is $100,000 less than the glossy brochure, which is $34,000 less than the average, which they're going to tell you this product averages. You need to run your own numbers. And when you need to use money that you can afford to lose in investments. Money you can't afford to lose, you need to save, and you need to put it in a savings place that you're going to earn money, hopefully tax-free, and you can use it whenever you want, not a 401k. So the next thing is, hear this all the time down here, pay off high interest credit cards with a low interest mortgage. The problem is people think they're paying APR. That's how they sell the product. They'll tell you, oh, get a 4% APR, get a 3%, get a 5%. When I do talks in front of people, I'll ask people when they have mortgages, and I ask them this question. How much interest did you pay? Did anyone have a mortgage? When they raise their hand, I say, how much interest did you pay last month to your bank? And they will, every one of them quotes me APR. And they'll tell me APR is annual percentage rate. I have it highlighted in red because I call it the average person's rip-off rate, because you're not paying that amount. You're paying a lot higher. If you're getting 5% over 30 years, you're going to pay 90% interest on the money you borrowed. So if you had this house for 30 years and you had a $300,000 mortgage and you were paying 5% APR, that you would pay $1,610 a month. So if you had it for 30 years, you'd have to make 360 payments. So you would pay $579,000 for this property. What people do is they buy a house, they sell it years later for $600,000. They tell everyone, hey, I doubled my money. I bought it for $300,000. I sold it for $600,000, but they didn't, because they forgot they only borrowed $300, but you need to subtract what you paid from the amount you borrowed. Just in interest, they paid $279,000. So you paid $300,000 for the house, and you paid $279,000 for the bank's house. That's how the banks make money. So when they're telling you, hey, if you can save on overdrafts, if you can do this and that, yeah, you could save $100 a month. But there's a lot better ways you can save money. You just have to stop giving it away, and we're giving it away to banks, lending companies, leasing. When we're leasing cars and things, we're literally giving money away. So I always call it, have you heard these fallacies? The lender says, hey, refinance, lower your interest rate and get a lower payment. Financial advisor, I know I've heard this one, hey, don't worry, the market will come back. When I talk to people right now, when the coronavirus hit, I always use this example. If you had $100,000 in your 401k, when the coronavirus hit, the average market went down about a third. So you went from $100,000 to $67,000 in 3 weeks. It might have taken you 3 years, because when Donald Trump got in and the market went up, everyone was riding the high, but then the wave crashed. Through nobody's fault, it was out of everyone's control. The problem is, financial advisors are great. I'm sure Victor's really great at what he does. The problem is, what they're not good at is predicting the future, when guys are going to fly planes into buildings and when the coronavirus is hit. Nobody knows that except the man upstairs, and he's not selling stocks and bonds. Okay, so they'll tell you, don't worry, it's going to come back. The problem is, you had 100,000, now you got 67,000. So even if the market came back, like it came back strong right now, let's say it comes back a third this year, you're not back at $100,000 because you're starting from a lower number. You're starting at 67,000. So a third of that is only about 22,000. So you're only in the 80s. It's going to take you at least 2 or 3 years just to get back to where you were. And that was just a little blip. So save money that you should be saving and invest money that you can afford to lose. The banker tells you, hey, save some money, avoid overdrafts. But really, where is your money going? Where's all this money going that I made? Because I see people, they're stressed out while they're working, then they lose their job and they're really stressed out because now they have bills, they don't really have anywhere to go. So what can you do about it? What's the answer? Well, How can you save more than just chump change? You know, hey, don't write checks for more money than you have in the bank. Well, okay, we all understand that. It tells us in the Bible how to handle money. And one of the biggest rules, I mean, this is probably the first financial book ever written, but people don't read it. And Proverbs 22:7 says, the rich rule over the poor. The borrower is slave to the lender. Victor and I, one time, he'll remember this. We were standing outside on the portico of church. And he told me, he said, Bill, if there were 100 people in line from here to the street, he said 97 of them would be standing on the line for loans, and only 3 of them would be standing on your line. I go, yeah, I know that. And only 1 would end up doing it, because we have been brainwashed to do things the way the banks want us to do it. And we continue to do it that way. Actually, what they're doing is they're robbing from us without even using a gun, because we're willingly giving our money away. So I'm going to show you what Karen and I see every week, sometimes 2 times a day. We're going to show you actual people, actual cases. And it's kind of shocking when you look at it. This particular person, he lives in New York, actually. He's a small business owner. And what he does, he builds bicycles. When Walmart orders bikes from the bike company, they come in boxes. He has guys, they go to Walmart and they assemble the bikes. They go in and assemble the bikes, okay? He had debt. He had a mortgage, you know, credit card, automobiles, like everyone else. It was going to take him 20 years to pay it off. Now, his mortgage and everything else, he only owed $298,000. But by the time he paid it back with interest, he was going to pay $472,000. And the problem is, he was going to pay $174,000 just in interest. Well, let's take a look at what that means to him. Well, that's $7,279 a year just in interest. Doesn't seem like a lot, but if you divide it by a monthly figure, $606 a month is doing absolutely nothing for him. All it's doing is enriching the people he owes the money to. He's paying on his payments almost 37% of his money. He might as well just throw it in the trash can, not doing anything for him. Here's somebody else. This is a school teacher. She had a mortgage, a very low mortgage. She lives here in Fort Lauderdale. Her problem, she had $113,000 she owed. She was going to pay back $161,000. Her problem, $48,000, almost $49,000 just in interest. It's only $3,600, almost $3,700, $307 a month. Now, a school teacher, they don't make a lot of money. $307, how much gas is that? How much milk and bread? 30% of her income, interest. Let's take a look at another guy. This guy happens to be a supply chain professional. This is family. 29 years, almost 30 years to pay off his mortgage and everything. He only owes $573,000. He's going to pay $918,000, but he's going to actually pay more because people continue to borrow. He's going to pay $334,000 in interest. That's $11,000 a year, $900 a month, 37% of his income in the trash can. Let's look at this next person, a banking professional, no less. 60 years because he had student loans. 60 years, owed $479,000. The real debt, including the interest, is $692,200. That's the problem right there. You can see it, everybody. It's only $3,500. Is that right? Yeah, $3,500, $294 a month, almost 31% of his income. These are the last 2 I'm going to show you. This guy's an attorney. This guy made between him and his wife, $350,000 a year. When I showed him his numbers, he had a nice house. He had a second mortgage on it because he fixed it up. Really nice. But he's going to pay back $1.2 million over the next 30. He was 59. He was going to be 93 when he paid off his debts. And his problem was $571,000 in interest, $16,000 a year, almost $1,400,000 a month, 46% of his income. He's making $350,000. He's really only making about $160 because the rest is taxes and interest. He's just trashing his money. Last one, this guy supplies wine and food to stores. 25 years. Whoops. That was his balance, what he owed. If I asked him what he owed, this is what he told me. That's what he was going to pay back. That was the amount of interest he's going to pay. $11,000 a year, $931, 38% interest. So why does all this happen? How did we get in this mess? Well, back in 1910, actually, there was a meeting off the coast of Georgia. There's a book written, and it's called The Creature from Jekyll Island. And it talks about the Federal Reserve. Do we know what the Federal Reserve is? Some people, yeah, they know. They named it Federal Reserve because they want people to think it's a government entity. It's not a government entity. It has nothing to do with the government. They just put federal in so that we all believe it's a federal entity. So they say it's a Federal Reserve. Problem is, there is no reserve. And the only banks are private banks. They're run by the banking cartel in New York. And here's the real sickening thing. What is the federal banking system? Well, here's what happens. You walk into a bank, let's say that's you, and you're walking in with $1,000. And we call it a deposit. But essentially what you're doing, you are making a loan to the bank. The only problem is you're not dictating to them what the interest you should get. You're giving them your money and they're dictating the interest rate to you. And once they have that money, that's their money. So what happens is you stick the money in your bank, one depositor. They're going to loan that money, let's say, to a businessman, your $1,000. Then somebody else is going to get the same 1,000. Then another guy's going to get 1,000. Another person, yet another one, another one, another one, another one, another one. So my question to you is, where did the other $9,000 come from? You only put $1,000 in. How did they loan out all this money? Well, the law is they only have to have 10% in reserve. So where did the other money come from? The answer is it came out of thin air. There is no money. All they did was put numbers in your bank account. And the problem is when you run into financial stress and you can't make those payments back, they're going to take your car. They're going to take your house. They're going to take your credit rating, and they're going to make your life miserable. So just stop thinking that banks are your friends. They're your friends until you can't make the payment. Now, you're going to have a lot of time to ask questions because I'm done. I'm just going to put she'll unmute herself so she can help me answer questions. If you want, we're going to send a book that you can read. It's a PDF. She's also, I think she put it in the chat. She put a link. She'll do it again when she gets a chance to talk. She can put it in, and we have a link. It's about an hour and 20 minutes, and you could watch the man that wrote the book about how the Federal Reserve came into existence. And it will wake you up if you start to really pay attention to your financial situation, your personal numbers. You don't have to make major changes. If you make small changes and control your finances, say you get a job, the next time you're out of work, you're not going to have that financial stress because you're not going to be giving money away, and you're not going to be, you're not going to be a debtor. And just like the Bible verse says, Borrower is slave to the lender. And until you decide to not continue to become the borrower and get away from the lending opportunities, we're going to have the same problem. So Bianca, I'm done. Anyone who have questions? That was pretty good. It was only about a half hour.
Just
Okay.
so everyone knows, I've placed the links in the chat box. You have the free download. Go ahead and grab it. You also have the video from the creature from Jekyll Island. Awesome video to watch. And if you ever have any questions, my information is there.
And we're not going to hound you. We're just going to send you free information. If you want it, read it. If not, you know, that's up to you. Go ahead, Bianca, take it away.
Okay. So I'm sure you guys, aren't you curious about how or why? And I know we're not talking about individual circumstances, but does anybody have any curiosity questions, you know, of what Bill was talking about? Because, you know, it's funny, I was solicited last weekend for a piece of property that I have up in Port St. Lucie, and my phone has been ringing off the hook because evidently there's a developer that wants my property, but they don't want to pay me what I want. So I was talking to somebody and they said, well, Bianca, you only paid $8,000 for that property in 1980. But exactly what Bill said, I did. I wrote down all the taxes, the improvement, yearly I make sure it's cleaned. And, you know, just to recoup my money, you know, they'd have to give me it was $70,000. And they don't even want to offer $70,000. And of course I want to make a profit. I don't want to just sell it for that. So they asked me what I was thinking, and I threw a number out there of 120,000, and they had started to choke on the other side of the line. But I know that the property has been up close to that before. So I'm not in a hurry. I'll just wait a little longer, right? But aren't you guys curious about what's being said here at all? No one has any questions how you can keep more of your money? Because that's really what this is about, keeping more of your own money.
See, what happens a lot of time, people will get a credit card and we look at it as if we just got a $5,000 raise. And we use it. And I always use this example when I talk. And it happens. You can pick any number you want. I just happen to pick 5,000. Does anyone ever have a $5,000? You have a credit card, you got $5,000 on it, and you're paying on it. It seems like forever. It just never seems to go down. It always seems to hover right around $5,000. And you might have the money in the bank. I hear this all the time, but I don't want to take it out. That's like my safety net. So they have money in a bank and they're earning, you know, 0.002%, and they're paying taxes on it. But yet they're paying 24% on credit card debt. I always say to people, how are you ever going to get ahead? Is that some kind of new math that you're doing? You have more money going out than coming in. Guys in an office, what happens is they're paying all this money on credit cards. They're driving leased cars. And when they go to the water cooler, they'll stand around the water cooler and they'll argue back and forth who made the biggest return on their investment. And Victor could tell you, probably they're thrilled if they could make 10% on some deals. I mean, you hear about the big ones, but if somebody could average 12%, they'd be taking Victor out to dinner every night. The problem is you're paying out 15, 20, 25% on the other end. And we don't even think about it like Bianca just said. We're just blindly giving our money away. So let's go back. You got $5,000. You don't want to take your money out. Most people don't have the 5. So what they do is they say, you know what? I'm gonna bite the bullet. I'm gonna pay an extra $500 a month. So the minimum payment is $50. I'm going to pay $550. I'm going to do that for 10 months. At the end of 10 months, I'm going to have this paid off. I'm only going to owe interest. But the problem with doing that, you write the check, $550, you mail it, or you hit the button. The minute the money comes out of your house, out of your account, you either walk by your car and you need a tire. Can you get one tire? No, you need two. Well, the hot water heater's broken. Call the guy up. He comes to the house. Yeah, I can fix it. $450. So what do? Where's the $450? You just sent it to Capital One. So what do? Use the card again. You thought it was going down. It went right back up. And that's the problem. People don't account for the surprises in life.
Bill, you want to talk about the mortgage. Somebody has a question.
I saw that. I was going to address that.
Go ahead.
Here's the problem. I'm going to give you another story. Gentleman came in my office. His name was Carlos. This a couple of years ago. I'd use a different tack now, but he came in. I happened to ask him, people think mortgages and auto loans are not debt because everybody has them. They only consider credit cards. He came in and he said this. I asked him, Carlos, you have a house? Yes. You have a mortgage? Yes. What are you paying? What's your mortgage payment? He goes, well, what I pay is $2,500, but that's not my mortgage payment. So I said, well, what's your mortgage payment? And he said, $1,500. So when I work with people, I like to ask questions that I know the answer they're going to give me. I always say, we're in a play. They just don't know what they're in a play. So I ask the same questions of hundreds of people. They all tell me the same thing. So I said to him, well, if you're paying $2,500, the mortgage, how come? Why are you paying an extra $1,000? Well, we know why he's doing it. Wants to pay the mortgage down quicker. So I asked him, why are you doing that? He goes, oh, I want to pay the mortgage quicker. I said, let me tell you why that's a bad idea. Let's say you do that for 2 years. You pay the mortgage, you pay an extra $1,000 for 24 months. How much have you given them? Oh, $24,000. Now let's use this term. Now the coronavirus hits. Boom, you out of work. Or like what happened to Tom. Tom, do all this work. We got to get all this work done. He got it all done. He's expecting a bonus. The bonus was out the door. So the problem is now you've given that money away. You can't, you lose your job, or you can't get a job. You can't make the mortgage payment. House goes in foreclosure. You lose the house, you lose your mortgage payment. And the worst thing is you lose your $24,000 because that's not theirs. That's your money that you willingly gave it to them ahead of time. So I always tell, and I said to him, I said, you have a wife and kids? He said, yeah. One of them goes in the hospital. You get a bill, $218,000. We all know what the health insurance is like. I said, but let's say you're lucky and your insurance company says, we'll pick up $200,000, but Carlos, you got to come up with 18 grand. Can you go back to the mortgage company and say, hey, I overpaid you $24,000. I need 18,000 back? What are they going to tell you? They're going to tell you, sure, come on in. We'll give you a second mortgage or let's refinance. The problem is people, and Kanye said this, people are giving their money away willingly, not anticipating surprises in life, and they come. You get sick, somebody gets hurt, the coronavirus hits, guys fly planes into buildings. Now you need that money and you have to go back to the people that you gave the money to and hope that they're going to help you. They are never, ever, ever going to help you. The only one that's going to help you is you. And sometimes the people I talk to, that even scares me, because the thing you need to be is disciplined. You don't have to eat cat food on crackers, but you need to be disciplined with your money and do the right thing. And the first thing you can do is not be paying these credit card fees and giving the money away to them. The other thing is, is leasing cars. There's a better way. You just have to turn the corner. And, I always call it, I say, look, this is credit card cocaine. Everybody wants to get off it. They just don't know how. And, all I'm saying is take the time and do the education, do the reading. I mean, Like Karen said, we have a ton of things we could send you, videos and things from online that we've looked at. And you do your own education and you do what's best for you, not what's best for somebody else or the banks.
Did you answer E. Kanye's question? Because I don't think you answered E. Kanye's
She
question.
said she's overpaying her mortgage.
No, she says that she's paying her mortgage.
Okay.
What can she do to not pay them more money than she borrowed?
Well, put that money, you know, and I'm not here trying to get people to do what I do, but you need to find a place to put that money other than a 401k, because when you want to take that money out of there, you got to pay the parole, which is called the penalty, to get it out because you put it in prison. And sometimes people put it in prison for 10, 15, 20, 30 years. So you need to put it somewhere, and there's places to put it. You got to do the investigation. Put the money somewhere where you can get at it, and don't spend it foolishly. And then when you have enough money, start whacking off your debts one at a time. And then you always hear it said, pay yourself back. Put that money back into the vehicle you're using so that it'll build up again and take care of the next one. Don't be giving your money away. Keep your money under your control. The problem people have when they do that, they have money in the bank, and then before you know it, they're driving 2 Lexuses, and they got they have a motorcycle, they got a boat, they got a bigger house, they went on a nicer vacation. Those things are good. Not in excess though, because, like Bianca said originally, hey, I've gone through the ups and downs. I mean, Bianca could tell you the stories, when I used to slither into the church there because I was so low. But, the thing I learned is I got that way through no fault of my own, except financially. I could have been in a better position if I was a little smarter with what I do. So what can you do with the money is not give it away to somebody else.
Okay.
So take a look at the, take a look at that book. The book that we're giving you is the solution that businesses use, our government use, the banks use to keep their money. So we're giving you well-documented ideas on what you can do with your money to use it twice, to protect it, to pay less taxes, and to start financing yourself. And there are other ways to do it, but the book will send you in the right direction.
Okay. I have a question here for either you, Karen, or you, Bill, from Kristen. It says, how about student loans? How can I pay them off within 10 years without having a major monthly payment?
No, there's a couple of ways. One thing I would say, based on what I do, don't consolidate. They all want you to consolidate. But let's say if you went to college and if you went to college and you went for 8 years or 8 years, 4 years or 5 years, you probably have 8 or 10 loans. So when you go talk to them, what they want you to do is consolidate those 8 loans into one big loan. And they average the interest rate. The problem with that, let's just say you went for 4 years, so you have 8 loans, and maybe you borrowed $4,000 or $5,000 a semester, let's say. So, $5,000 a semester, that'd be $10,000 a year. So, you got $40,000 in loans. It's a lot easier to pay off a $4,000 loan than it is to. It's going to take you a lot longer for $40,000. The other thing that people do when they pay student loans, you've got that little portal there. When you send the money in, they put the money wherever they want. They'll pay a little bit on each one. You can tell them that you want all the money to go to this one loan. By doing that, that one will be gone quicker. And then you can work on the next one. If they put it out over all 8 of them, it just takes longer. They're going to do what's beneficial to them. You need to really, it comes down to what we said. Talk to the right people. And I know it's hard because when you talk to guys that are salesmen, they're trying to sell you. In my business, I always say, if there's 3 of us standing there, unfortunately, I hate to say this, 2 are crooks, because all they care about is their commission. I guess the hard part for the average person is weeding out, the good from the bad. But that's just life. They're trying to sell you, a guy like Victor who's going to do the right thing. There's other guys out there that are just trying to make that commission. They're not trying to do the right thing. Everything that we do, Karen and I, is totally guaranteed. You cannot lose money. You just have to, you don't have to, but if you follow the plan, it'll work just as the way it's supposed to.
Bill,
Yes.
Poor Kristen said, oh no, I consolidated. So she's screwed. So maybe there's another way that you could help her.
Well, not necessarily screwed. The problem is that's what they tell you to do. So that's what people do. And you can imagine if you had, one semester you may have taken $3,000, maybe another semester you took $5,000, then you had one for $4,000, $6,000. You got all these different loans. It's easier to whack off that $3,000 one. Then it's like a mortgage. When I work with people, the last thing that gets paid off is either mortgages or student loans. They usually get paid in I have a woman right now, a girl, that was going to take her 40 years to pay off her student loan the way she was doing it. And she's using a little bit of money. Actually, she just called me. She's been doing it now for, I think, 2 years. And now she says she wants to, I call it a bank. She wants to open up another bank. And instead of 40 years, right now, it's going to take her 10 years to pay off her student loans. If she opens another bank, it'll be a lot less. But, everybody's different. It's not like the worst thing in the world to have consolidated your student loans. But I always tell people, if they haven't done it, don't do it. In my opinion, somebody may tell you something different, but for what I do, it's much easier.
Okay, we got more questions.
Go ahead.
Okay. People that are asking about the book, Karen just put it up again. Don't forget, at the end of this program, you can go to the bottom of the chat and hit the file, except if you're on a phone, it won't let you do it. But if you look in the chat, it's in the middle. It's also at the end of the chat from Karen. And actually, if you have a pen and you want to write it down, it's debt2cashflow.com. Pretty easy. Debt2cashflow.com. So the question here, there was another question. 1 second, let me scroll up. Katrina is asking, she's trying to save. How do you save money if you have to use it to pay your bills?
Well, here's the, just being frank with people. Sometimes I meet people and they're paying the minimum payments, or they're not even paying. And maybe they're not even putting money into a retirement plan. Some people I just can't help. What most people are doing is, the easiest way for me to find money is they're overpaying I always call it overpaying their credit cards. In other words, minimum payment is $35, they're sending $100. They got another credit card, the minimum payment is $50, they're sending $150. They're putting $200 or $300 in a retirement plan. And when I look at their situation, I had the teacher that I showed you, she was overpaying her credit card $169 a month. She had 4 of them. She was overpaying one $169. Happened to be care credit, the dental stuff. So what she was doing, here's what they do. These are the tricks. We're going to give you 0 interest. If you can pay this card off the first year, you're going to pay 0 interest. So what is she doing? Minimum payment was $81. She's sending $250. Now, we know what's going to happen. She's going to struggle all year to try to pay that off. Something's going to happen. The car's going to break. She ain't going to pay it off. So not only do they add all the interest on top of it again, but now the interest rate's not 0 anymore. It's 20%. So all they're doing is protecting themselves by having you try to give them as much money back to them as they can get. And it's not proper planning. You need to really think things through. People always say, this is the other problem people have. They focus on interest rate. Well, I just showed you, annual percentage rate, 4%. The interest rate doesn't mean anything. It's how much interest, how much money they're giving, the volume. When you go to the doctor and you have to get a shot for something, it doesn't matter how, what the rate, how quickly they put it in your arm. It's how much they give you. If they give you too much, it could kill you. If they give you too little, you ain't even going to get better. It's not the interest rate that matters. It's do the numbers and you'll see how much interest you're paying. Sometimes a higher interest rate, if it's the right way. For example, credit cards, you're paying compound interest. Automobiles, you're paying compound interest. Mortgage, you're paying compound interest. So tonight, I hate to tell you this, if you owe a debt to anybody and you go to bed tonight and you don't pay it off, when you wake up tomorrow morning, you are going to be poorer than you are right now, because compound interest never sleeps. And you have to break that compound interest cycle, because they have you enslaved. We have become enslaved financially by banks and lending institutions. And it's all about the credit. So how are you going to do it? What I do with people when they come to me, I don't ask people to take money out of their pocket. And I'm not meaning to beat up financial guys, but when you go to them, they want to have what they call it AUM, assets under management. So when you go to them, they don't look at your debt, so to speak. They want to know, how much money do you have? Give me your money. I'm gonna grow it. So I always tell people, they only leave out one part. Give me your assets. The part they leave out is, give me your assets. I'm going to put them at risk and I'm going to grow them. And like I said, most of them are very good. They're really good at what they do. The problem is, on September 10th, 2001, if a financial advisor gave you advice, it might have been the greatest advice in the world. But on September 18th, you still lost half your money, because he didn't know that guys were going to fly planes into buildings in New York. If he did know that, he's a crook. I don't think most of them are crooks. He just can't predict the future. Whoever gave you advice in January, by March, you lost a third of your money. And it might have been great advice. Was it his fault? No, it wasn't his fault. It's out of his control. So that money, when you give money to a financial guy, it has to be money you could kiss goodbye. But what we're doing is, we're using money we should be saving and we're investing it. And that is a mistake. And the reason people are doing that, because banks don't make it advantageous to save money, because they're not giving you any interest. And the reason you don't put the money there, no interest rate. So you stick it, you put it in prison for 20 years. Now you may have $200,000 in your 401k. You may need $25,000 for your daughter's wedding or your daughter's car. And guess what? You only get to go to prison and look at it. Because if you want to take it out, it's going to cost you taxes and the penalty. The problem is, if a 401k was for your benefit, why did they come out with a Roth? If a 401k was so good, why did they come out with a Roth IRA? That makes absolutely no sense. Because why would you're working now. Most times people have money. You're young. You're going to be working. So what we're doing is, they tell you, don't, and you've heard this, don't pay taxes now, pay later. When you're older, you're going to be in a lower tax bracket. My question is, do you want to be in a lower tax bracket? I want to be in a higher tax bracket when I'm older. So now you're 45 years old, you're earning income, you're not paying any taxes because you put your money away. Now you're 75 or 80 years old, you're not working anymore. Now you take the money out, now you have to pay taxes? Why don't you pay it while you're earning the money, because it's a smaller rate? That money now has grown to $500,000. When you start taking that out, you're going to get hammered. The other problem is they told us you're going to be in a lower tax rate. The problem is they didn't think that those little things that were running around the house, we call them kids, but they're tax write-offs. They're all grown up and they're gone. You're in a smaller house. Maybe the house is paid off. Now all those tax breaks you have are meaningless. The other thing, let me get on CPAs while I'm at it. Did the CPA ever tell you this? I had a guy one time, he said he was going to pay his mortgage off, and his CPA told him, oh no, don't do that. That's a write-off. And I had to tell him, I go, let me ask you a question. Would you play this game with me? You have $100? Yeah. Give me $100 and I'm going to give you, what tax bracket you in? Let's say he's in a 25% tax. I'm going to give you $25 back. So you're going to give me $100. I'm going to give you $25 back. How long would you play that game?
Not long.
Not long. But that's what you're doing when you have a 401k. You're giving them $100. Like when you, well, not a 401k, when you're paying taxes, you're paying $100 in tax and interest, and they're giving you 25 back because that's your, and they're not even giving you the full 25 because they're giving you 25% off your adjusted gross income. It's the biggest ripoff in the world. The Federal Reserve, they think we know who Bernie Madoff is, the biggest scammer in the world. Peanuts compared to the Federal Reserve banking system. If you get an education and you learn where your money's going, find out a better place and calculate the interest. Any other questions, Bianca? You're looking, or Karen?
No, there was, a comment from Gina. She said you should specify that the extra payments for your mortgage goes towards the principal portion.
Right, that's true.
So if anybody's doing that, make sure you're specifying that if you're doing that. So,
and if you're doing that, if you need that money 6-8 months from now, you can't get it. It's gone. The other thing, well, then again, I'm not trying to promote what we do, but you can use your money twice. You can use your money and take care of the problem and still earn interest on it. You know, so not many places can do that. You know, I don't know what else to say other than, you know, take the time to get educated. Read, you know, Karen will send you the information. And if you want, I mean, Karen can put you on, she sends out emails. And, you know, sometimes there's videos in there and it's all, you know, at the end, it's not buy this and buy that. I mean, I get sick watching YouTube and Facebook and everyone's hawking their stuff and I just won't do it. You know, luckily for me, I have somebody like Karen, who brings me a lot of business people. I have my partner, he's in the credit repair business. So he constantly has people coming in with credit problems, but the credit problems are their debt to income. Basically everyone's paying too much money out. And when you look at it, it's interest, and we have a way of fixing it. Well, you have a way of fixing it once somebody shows you the way to do it. We're all doing it backwards. We're all overpaying, and you know, we're just doing things the wrong way because that's what we've been told to do. You know, no one ever taught us this. I bet when you went to school, everyone knows that Birmingham is the capital of Alabama, but that ain't helping you when you got to pay a debt. No one ever taught us, and the reason they don't teach this in school is because they don't want to teach you, because the people with the money want to keep the money. And that's just the way it is. And if you start reading things, you'll see that that's the way it is. Right now, this coronavirus thing, people don't like Trump or they don't like this. I'll tell you, it's all about the money. That's all it's about. Every single war that we ever had, it's all about the money.
Okay, you're on your political soapbox. Get off.
No, I'm not political. It's all about the money.
I have two more questions. That's more important. So Susan is asking, if we're not to invest in a 401k, what is an alternative?
No, you'd have to talk to Karen.
Read the book.
Right. Yeah, I'm not going to sell you anything. Read the book, okay.
And I have a question from Gina. She says, why did you mention not to lease a car? Read the
Okay.
book.
No, yeah, this will be quick. This will be quick. I do this with business owners basically because when I meet them when Bianca and I, when we can get back into the networking thing, a business guy, I always say to people, well, what do you do? You're at a networking event. What do you do? They're going to tell me, oh, I have a business, blah, 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 blah. If they ask me first what I do, I always turn it back to them because I want to know what they do because then I focus my talk on them. So a business guy comes to me, I don't care what he does, any business, tells me what he does. And then, I tell him what I do. I said, let me ask you a question. You're a business guy. What does a business owner do? As soon as he starts making money, what's the first thing he does? Sometimes I have to help him. Don't they usually lease a car? Oh, yeah. I said, okay. Do they lease Toyota Corollas? Oh, no. They want a BMW, a Lexus, or some big mother. Yeah, okay. So let's say it's $10,000 a year, about $800-900, right? A month. $10,000 a year for 4 years. At the end of 4 years, you've given the leasing company how much money? $40,000. And then you have a decision to make. Are you going to buy that car for $25,000 or are you going to turn it in? Oh, I'm going to turn it in. I want a new car. So you're going to do it again, right? You're going to give them another $40,000. So 8 years from now, you've given them how much? $80,000. And you have a decision to make. Are you going to buy the car or turn it in? Let's say you do this for 20 years. You've given the leasing company how much money? $200,000 plus all the interest you could have made on that money. And you still have a decision to make. Are you going to buy the car or turn it in? I say, why don't you let me show you how you can set up your own bank? You're going to buy that car personally. You're going to lease that car to your business. Your business is going to pay you $10,000 a year for 4 years. At the end of 4 years, you're going to have 40 grand in your bank back. And you're going to not worry about taking it to the leasing company and worry about every ding. You're going to trade that car in and get another car. You're going to do it for another 4 years. 20 years from now, you're not going to have $200,000. You're going to have $400,000 and you own the car. When I tell them that, they say, I think we need to talk. We're just giving our money away and there's better ways of doing it. And you don't have to take it out of your pocket because right now, when you are overpaying your credit cards, that's money that'll help you get out of debt. You're just using it the wrong way. That's the problem. And most people don't know how to tell you to do it. They'll tell you, put it in these stocks. Hopefully you bought Amazon. Then you can pay everything off. But most people don't buy it. If they bought Amazon, when Amazon went down, they all sold it. When Amazon went back up, then they bought it. They didn't make the money. The guys that make the money, are the guys with the big, the guys that stick the big money in there. Because when everyone else, you heard this, when you're selling, they're buying because they have the money to stay in the game. We don't have the money to stay in the game. So we got to be a little smarter just for our little world, but don't give your money away.
So everyone here is saying, great job, good info. They didn't know certain things. So I encourage everybody, I've got clapping by Fernando there. I do encourage everybody, it's free to read those 2 documents that were in the chat. If you cannot copy the chat, like I said, right now, if you go to the lower right-hand corner, all the way down, scroll as far down as you can, you'll see a little thing that pops up and says file or 3 dots. If you click on that, it will allow you to copy the chat. It will copy the chat right to your desktop or your iPad, and then you can scroll through it and read whatever it is, get everybody's information. But again, that ebook is called debt2cashflow.com. Just the name of it should want to make us want to read it. Thank you so much, Bill. It was a great presentation. Sorry about the soapbox thing, but we all can get carried away. But it was good information. It wasn't that I was trying to stop you. I just wanted.
That's okay.
I just wanted to make sure all the questions got answered because there were so many, and every time I thought I was done, there was another question. So, thanks for the participation from everybody. I'm going to just slide this bar over because I want to see everybody. I want to thank everybody for coming. I know sometimes we only come when the topic interests us, but there's going to be opportunities along the way when you're going to have an opportunity to say what you're doing and where you're at and all of that. I want to just, since we have a few minutes, I want to see on the call how many people, you could just raise your hand, how many people are on the call because you are in career transition? Can you raise your hand? So I could see, I got Gina, I got Deb. Who else? I got Susan. I think, did I miss anybody? Do I have everybody in front of me? Yeah, okay. Joe, are you in career transition, or Juan? Because I can't see you. No answer. Okay. So, all right. So because there's only 3 of you, I want you to just let us know. I'm going to pick on you first, Deb. If you can give us a 2-minute, what you're looking for and, you know, how we could help you. Tell them your name and all that.
Okay, I'm Deborah Guzman. I'm actually in transition at this moment, and I'm looking more like account management or executive administrative assistant job. Actually, I was doing that in a law firm, front desk /